Welspun Enterprises just came out with its numbers a while back, and the numbers look, boy, pretty good, 10.5% higher. And look at the numbers. The top line has more than doubled, 122% higher. Profits are nearly come in at 25 crore versus nearly 7 crore which was seen in the corresponding quarter, and it's been a very, very good operating performance this time around. The EBITDA figure is 45 versus 0.75 that was seen in the corresponding quarter, and the margins have come in double digits at 11%. Let's check what led to this strong performance this time around for Welspun Enterprises. Joining us now on the show is the MD and CEO of the company, Mr. Sandeep Garg. Hi, sir. Good afternoon, and thanks a lot for joining us on Bloomberg Quint. First of all, congratulations on very, very strong set of numbers. If you could tell us what led to the strong growth this time around for a company like yours.
Thank you very much. Appreciate your words of encouragement. The results are there because we have been executing the Delhi Meerut project very efficiently. As you may be knowing that this project, which was scheduled for 30 months completion, is getting completed in 16 months. This has led to a turnover being faster and accordingly reflecting into our turnover as well as margins, which went up. We are now poised to grow for further 2 years. We have now the clear visibility of the order, which currently stands at about 5,500 crores, including the order that we have opened L1. So we believe that this performance that we have put in the last quarter or the last year would continue to accelerate further. We expect that our revenue growth will be every year should double up. The visibility of the order book is there, and this growth that you see in terms of profits will also continue. So this is what led to I would say the excellent performance at ground of operational efficiency has led to the results that we see.
Mr. Garg, you're suggesting that this outperformance now will continue in the subsequent quarters as well. So for the full year, I'm just checking the numbers, 1,067 on the top line, and for the bottom line, almost 70 crore figure is there. Could you just give us a guidance what sort of growth that your shareholders can expect in FY19 now over the numbers that you've posted in FY18?
See, the current order, as I said, is now in the tune of 5,500 crores, assuming that the order that we have opened L1 of about 2,000 crores will be awarded to us. We expect our revenue growth to be almost double for next 2 years going forward. And our margins are practically in the same range. EBITDA is currently at about 15% of the top line. We expect a similar numbers to pan out going forward. There may be a slight at the infrastructure level. If you see at the segmental reporting, the profit margins are in the ranges of 11 to 12%, and we expect these to continue in the same range going forward.
Okay, so you're expecting the top line to double for the next 2 years, so which would mean by FY20 we can see a top line figure of nearly 3,000 crore for a company like yours. The finance cost, Mr. Garg, for the full year is 33 versus 10 crore, which was seen in FY17. What's the debt picture looking like? Looks like you've increased your debt in FY18. If you could tell us what's the current debt on the books and what's the reduction plan going forward?
The debt, as you see is basically because of the debt at the SPV level of Delhi Meerut project. The parent company is relatively debt free. There is hardly any debt on the parent company, and as we are in the hybrid annuity model where we will take projects and there will be debt at SPV level, there will be consolidation of the debt that will take place. But however, since this is backed by NHAI by way of making payments on an annuity basis along with the interest on bank rate plus 3%, this debt is serviced directly by the SPV, so it is not a load onto the parent company. as the order book will grow, there will be about 50% of the order will be through the debt in the various SPVs we will operate.
Okay, and 5,500 crore, as you said, is the current order book. What's the sort of visibility that's there in terms of orders for FY19?
We expect, including the order that we have opened L1, we expect in this year the order to be in the ranges of 7,000 crores we would want to book this year. Last year we booked about 4,000 crores, so we would gradually and cautiously grow the order book. That's our current aspiration, to book orders worth about 7,000 crores this year.
Okay, so 5,500 plus 7,000 is what you're suggesting, or that figure is included in 55?
55 plus another 5,000, so we expect about 10,000 to 11,000 order book.
For FY19.
And we expect about 2,000 crores to be, 2,000 crores to be executed in the current financial year. So we expect the order backlog at the end of the year to be somewhere in the ranges of 8,000 to 9,000 crores.
And what's the current backlog out of the 5,500?
It's about 3,500 crores.
Okay, fine. Fair enough, Mr. Garg. I think we'll leave it at that note. Appreciate you joining us, and all the best to you for FY19. Well, that's some positive commentary coming in from the management of Welspun Enterprises. As you can see, the stock reacted positively. They expect the top line to double for FY19. They posted nearly 1,067 for FY18, and they expect it to double till FY20. Margin picture, they expect the margins to be somewhere in that range of 11 to 15%. That's the bandwidth that he's given. Current order book of 5,500, and the visibility for FY19, what he suggested, is almost 10,000 crore.